Earnings season begins today right after the closing bell when Alcoa reports. Analysts are expecting to see the effects of a slowdown. Earnings per share for all S&P 500 companies are expected to have gone up in the second quarter, but by the smallest amount in 2 years. For more on what to expect, we're joined by Jim Paulsen. He's Chief Investment Strategist for Wells Capital Management. Jim, welcome to the show. You're always an optimist, so I wanted to get your take. Give me the positive spin on what was, by all accounts, a terrible jobs number on Friday. Why isn't that making you apprehensive?
Oh, it does, Margaret. No doubt about it. There's no way to paint Friday's report. It was awful. Even the internals were bad. So everything was pretty bad about it. Now we've had two back-to-back months. But a couple points on it. One is that it's not the only report of the job market for the month. We did have a very strong ADP report. We have claim numbers leading up to that report, which had come down and stayed in the low 400,000, suggesting a better number. We had ISM for manufacturing and non-manufacturing. Both of those employment components went up during the month. So there are other job reports that suggested a more milder decline in job conditions. We also, it doesn't jive so much with like retail sales, which were phenomenal here in the month. It doesn't jive with profitability, which remains good. So I do think, they come and goes. The ebb and flow is kind of the way data happens. And this is a bad one, but I'm not sure it means much more than we are in this soft patch. And I'm still looking for it to get better in the second half.
Well, the thing is with that, we had to add another data point in there. Cisco out there today, 5,000 jobs being cut there. On the retail sales front, fewer and fewer companies are releasing results. And what they are saying is there's a huge wealth gap right now. They aren't seeing those who aren't in that upper echelon of income spending money. So with those 2 points in mind, I mean, how do you allocate towards safe stocks?
Well, let's just step back for a minute on jobs this year. Even with those two bad job numbers, Margaret, we have created about just shy of 160,000 private payroll jobs a month this year to date, compared to only 98,000 a month last year. Year to date, the rate of growth in non-farm employment is up 1.8% annualized, compared to only 1.1% last year. Hours worked in the second quarter, believe it or not, we're up 3.3% in the quarter on an annualized basis. That's the strongest quarterly gain in hours worked in any time in this recovery. So I still think we're making progress in the job market, and that might be why retail sales are holding up better than what people expected. I think Cisco's got specific issues, by the way, dealing with the impact that Apple has had in convergence to a single device and what that means for the PC market.
Okay. Well, earnings season begins today after the bell. What would you have to hear from corporate America that would make you doubt a market climb like you're expecting?
Well, I think the earnings season is going to be an interesting one, Margaret, because I think the market's going to be more focused on what we're seeing through the windshield, not necessarily in the rearview mirror.
Right.
Now, what I mean by that is I think we're going to be more concerned about what weekly unemployment claims are saying about the second half, about weekly retail sales numbers are saying in the second half, than we are about what Alcoa made last quarter. But the one aspect of the earnings season I think that's going to be interesting will be company commentary. And I think that, because that will be a look through the windshield. And I think company comments that say that they're not seeing top-line growth, company comments that saying that they're more concerned about keeping operations lean, those types of things I think will be felt in the equity market. And overall, I think the season, as far as reports, might be a little disappointing because we certainly have been in the soft patch.
But you do believe that the housing market has bottomed out here?
I do. I think you look at new home sales, you look at housing starts, you look at the Case-Shiller price index, all of those current readings are where they were almost 2 years ago. We've been in a sideways trend ever since. I just think we've got wind at the back of the boat here. We got mortgage rates that have come down since the spring. We've got energy prices which have come down over that period of time. We're going to get a positive from Japan now rather than a negative. So I still think we're going to have reacceleration of the data that's going to start to show up either August or September here. And that, I still hopeful, is going to take this market to new highs for the recovery cycle.
Well, I know, I love this phrase you have in your report. You think we're suffering from Armageddon hypochondria right now.
Yes.
But at the same time, what we seem to be understanding from the latest data points is that in some way they are divorced from the consumer experience, from the consumer level of confidence right now. The market has climbed since those March lows, but look at the jobs number. That's not telling us what's happening in the middle of this country.
Well, I don't know. Like I said, job creation year on year in private is up 1.6. I might not believe this either, Margaret, but if I look at how this job market is doing relative to the last two recoveries, in 1991, at this point, 2 years into the recovery, we had increased non-farm payrolls, private payrolls by 1%. That's almost exactly what we've done here. We're up 1%. At this point in the 2001 recovery, we had lost 1% of our job base. So we're actually doing better than 2001, and we're doing in line with 1991. Yeah. The job market, to me, is doing better than people think.
All right, Jim. We'll see what earnings season shapes up to be when it kicks off after the close today. Thanks for giving us your perspective.